Welcome to the SWIB Market Update. I'm Chris Preisler, Communications Specialist for the State of Wisconsin Investment Board, or SWIB. Each quarter, we'll talk to SWIB staff about the economy, the markets, and how the Wisconsin Retirement System trust funds are impacted. We'll also discuss how SWIB is working to help the WRS remain among the nation's most resilient pension funds, growing and protecting participants' benefits, and giving them peace of mind to focus on work, life, and the future. Please make sure to subscribe in your favorite podcast app so you don't miss an episode. Share this podcast with your fellow WRS members and leave a review on Apple Podcasts so it's easier for other members to find this show. Today, we welcome Jeff Lucas, a senior portfolio manager on SWIB's Fixed Income Strategies team. Jeff, welcome to the SWIB Podcast Market Update for the second quarter of 2026.
Thanks for having me.
So Jeff, let's jump right into it. The second quarter saw continued debate around inflation, Federal Reserve policy, and economic growth. How did those factors influence fixed income markets during this quarter?
So I'd say the prime drivers of the fixed income market in Q2 were economic data, the war in Iran, and the impact that that had on the oil markets. So in terms of economic data, in Q2, we had three really solid employment reports, put upward pressure on interest rates. The inflation readings that we saw were probably a little more in line with expectations. I think there had been fears that they had been higher given the impact on the war on energy prices. But core readings, which the market and the Fed tend to really focus on, were, although still elevated relative to the Fed's target, not as high as the market had been afraid of. Then we also had, as I mentioned, the war in Iran and the impact on oil markets. The bulk of the initial move in oil happened in February, with WTI crude prices trading from the mid-60s prior to the start of the conflict to just north of $100. We did see that spike to over $110 in the first week of April, but that was really a kind of a one-day price hit and then moved back and kind of chopped between $100 and $110 through mid-May. Market was concerned about the inflationary impact of the higher oil prices, and that was in an environment where inflation is already running above the Fed's target. So where we saw this impact the fixed income markets most heavily was through shorter term interest rates, looking at, say, yields on the 2-year and the 5-year U.S. Treasuries. Those moved higher as the markets moved to price in more Fed rate hikes to offset the potential inflationary impact of that higher oil price. We also did see some increasing growth concerns. So that would be an offsetting factor. But for the main part, we saw higher interest rates as a result of those higher oil prices and the stronger economic data.
So what are your thoughts on new Federal Reserve Chair Kevin Warsh, and how do you expect him to redefine the Fed under his leadership?
So the FOMC meeting, that's the Federal Open Market Committee meeting on June 17th, was highly anticipated given that it was Kevin Warsh's first meeting as chair. And given the current macro environment and some of the views that Warsh had expressed during the run-up to his nomination and also in his confirmation hearings, we were surprised, as was the market, by the more hawkish than expected outcome of the meeting, particularly the strong emphasis that Warsh placed on restoring price stability and seemed to convey little concern for the labor market at this point. The overriding message was this focus on price stability. And that's not to say that Powell's Fed was not concerned about price stability, but there was a particular emphasis on it at this meeting. And we saw it both in the statement and in Warsh's press conference that followed that. Another thing I would say that's going to be interesting to follow here with Warsh, and I think he's clearly looking to change as he takes over, is Fed's communication with the market. And he has been on record saying that he thinks that the Fed over communicates. He's not been a fan of what we call forward guidance, which is where the Fed tries to give the market almost a heads up on what it's thinking and how it's going to react to data, how it expects policy to evolve. And so what we saw in both the statement and his press conference is that he's clearly looking to cut back on that communication and that forward guidance. The initially released statement was significantly shorter than what it had been under Powell. Another part of Fed forward guidance historically has been what has been referred to as the dots. And this is essentially the Fed's rate forecast. We also get the summary of economic projections. And what this is basically members of the committee will provide their outlook for growth, for the unemployment rate, for inflation, and then also where they expect interest rates to be over the next couple of years as well. Warsh himself did not submit any forecasts. He has been quite critical of both the DOTS and the SCP, the Summary of Economic Projections in the past. So I think by him not submitting his own forecast, I think one, it's him showing that he wants to try to phase out the DOTS and the SCP. So I would not be surprised if we see those go away at some point here in probably not before the end of the year, but if we look out into 2027, that's one change I think that we'll see from him. The other thing I would note is that he announced the formation of 5 task forces to review key areas of monetary policy. Those include Fed communication, the Fed's balance sheet, use and reliance on existing data sources, productivity, particularly with AI and the AI impact on that productivity, and then also the inflation framework. So I think in terms of his desire to reshape the Fed, I think these 5 task forces provide a good idea of where he wants to change the Fed. These are areas that he has focused on during his confirmation hearings. So some of these aren't really a surprise in terms of areas that he wants to focus on, but he is definitely starting out proactively trying to make these changes here.
So Treasury yields moved throughout the quarter as investors reassessed the outlook for interest rates. How did changes in the yield curve affect opportunities and risks within the fixed income portfolio?
So in Q2, as we kind of have touched on earlier, we saw Treasury yields move higher. The yield curve flattened, which means that yields in the shorter end of the Treasury curve, in this situation, since yields were higher, it means that those yields at the front end, say 2 or 5 year maturities, increase more than yields on longer maturities, whether it's 10 years, 20 years, or 30 years. So that was one defining characteristic. And as I mentioned earlier, too, those moves were a combination of economic data, the war with Iran. And the other thing I would say is also the Fed itself, because we did have a couple of Fed meetings during that time period. So as I mentioned, we had 3 strong labor reports, employment increasing more than expected. Inflation was rising on a headline level, a lot of that due to the energy price increase due to the war. In general, core inflation measures didn't see much upside surprise, but some of the more narrow gauges, measures that the Fed looks at and the market looks at remained elevated and inconsistent with the Fed's goal. And as I mentioned too, is much of the initial impact on oil prices, while it occurred in March, the potential inflationary impact of that continued to filter through in rate markets in Q2. So with those moves higher in yields and the flattening of the yield curve, it provides opportunities for us to either trade with a continuation of those trends or for a potential reversal if we evaluate this and say, okay, it looks like we think the market has gone too far and priced in too much, for example, for Fed rate hikes. Just as an example, following the Fed meeting on June 17th, we saw large moves in market expectations for future Fed rate hikes. And so part of the evaluation for our fixed income team is if we think that those rate hikes are going to be realized, or if we think the market has kind of overreacted, we need to maybe take the opposite side of that and price that out. So when we have moves of these size, it does provide a lot of opportunities for us to go in and kind of trade around those. And those are basically opportunities for us to position the portfolio to outperform our benchmark.
So credit spreads remained relatively tight despite ongoing economic uncertainty. What are you seeing in corporate credit markets, and are investors being adequately compensated for risk today?
Sure. So in the investment grade market, spreads on the corporate index is trading at basically 20-year tights at this point here. And the tighter spreads basically mean you're getting less compensation for that credit risk that you're taking. So what we've seen in the investment grade corporate market, which is the market that I've focused on, we've seen increased supply as we've seen a lot of issuance related to AI data centers, to its so-called hyperscalers, which usually comprised of Amazon, Google, Meta, Microsoft, Oracle. So as I mentioned, we've seen this increase in supply, but demand has been able to keep up. Treasury yields have moved higher, as we talked about earlier, but that has also been one factor that has brought in excess demand. And so despite the tight spreads, we've been able to see this demand that has materialized to keep spreads from widening out at this point. I will say there are certainly some risks that we've seen. Now that supply, which has been met with demand so far, is certainly one risk there. At time of recording, we've seen $725 billion issuance of bond deals or more come to market so far this year, which is more than the total we've seen over the last 6 years. Those hyperscalers that I've mentioned, in addition to SpaceX, have issued a combined $182 billion of investment grade debt this year. And that compares to $13 billion from those issuers in the same period last year, according to Bloomberg data. That is certainly one risk there. So other risks that we see, a lot of them are actually related to this increased supply. I'd say one is certainly that at some point, the market gets saturated with the supply and just the risk appetite is no longer there. We started to see this maybe just a little bit with the Amazon deal, where demand was much lower than it was even for the deal that they came with back in March. They also had to price it with a lot more concession relative to their existing bonds than they did previously. So that's one sign that maybe we're starting to see a little weakness there. There's some factors that maybe kind of offset that a bit. Potential economic slowdown. We don't see that yet in the near term, but that's certainly one factor that could play a role. Private credit, something that has been out there in the news, could be one factor. Again, not seeing big risks there. And some of these other risks are kind of related to these. So balance sheet deterioration from corporates, a lot of that would be related to, say, economic slowdown if they started to see demand and their credit stats started to slow down. Another factor potentially could be U.S. Treasury yields falling. That tends to see corporate spreads widen in that situation. Having said that, I think in this current environment, though, there's still a number of technical factors that are supporting the IG credit market, one of which being high all-in yields. Other factors include, economic growth has been quite good. Earnings have been strong. And so it's kind of this almost equilibrium at the moment where all those factors tend to balance out and are keeping the market from widening out much at this point. So how that's impacting us and how we position the portfolio is we're being cautiously optimistic, not taking too much risk on the IG side, but still recognizing that there are a number of factors that could keep us at this low level and keep us from widening out for an extended period of time.
So fixed income has traditionally played an important role in pension portfolios as both a source of income and diversification. How is the asset class helping support SWIB's broader investment objectives in the current environment?
So historically, the correlation between returns for equities and fixed income has been such that when equities sell off, interest rates usually go down. And when interest rates go down, bond prices go up, which means that bonds are typically seen as a stabilizer and a source of diversification that provide positive returns in periods when broader risk is selling off. So that has been a benefit for SWIB's broader investment portfolio. So this isn't always the case. We've seen periods, particularly where the Fed is tightening policy or raising interest rates, where equities sell off and interest rates go up and bonds underperform as well. Most recently, we saw this in 2022 when the Fed was hiking rates. But in general, if you look at it through economic cycles, interest rates decline when the economy weakens or goes into a recession. Equities generally sell off during that period and bonds increase as interest rates decline. So I think we look at this over a broader time horizon, and through cycles, it's a source of stability and diversification. If nothing else too, it's also a source of income. Those interest payments that we receive on the bonds that we own in the portfolio are a steady source of return for SWIB.
So finally, Jeff, as we look toward the second half of the year, what lessons from rate volatility of the past few years continue to shape the team's approach today? And what are the key economic indicators or market developments that the fixed income team is watching most closely?
So the market continues to require the team to be nimble and continuously reevaluate our positions. That's not necessarily something new. We've always done that. But it feels like in this environment and the number of things that have popped up in, say, the last year and a half, if I go back to Liberation Day of last year, where we had Trump's tariffs being announced, that was a big hit for markets, lots of volatility around that. And then Iran this year. It's just very important to be nimble and be able to continuously reassess your positions. In terms of what we're watching, in terms of economic indicators for the rates market, first and foremost, what we follow is inflation and the employment data. Those are the two parts of the Fed's dual mandate. So that's going to be particularly important, especially given where we are right now with the Fed potentially looking to hike and this renewed, maybe even increased focus on price stability. We obviously closely monitor other parts of the economy, particularly the consumer side, given how large a part of the economy that is. And at the moment, AI-related CapEx is also very important. Those also feed back into inflation on both the demand and the supply sides of the economy. And so we will obviously continue to focus on that. We'll also continue to focus developments at the Fed as we transition from a Powell-led Fed to a Warsh-led Fed, and some of those changes that we discussed in terms of communication, more focused on price stability, how those are going to impact the rates market. In addition, we've even seen it the last couple of days here, any new developments in the Middle East are going to be very important. These renewed strikes that we've seen, both sides showing concern about the durability of the ceasefire. Oil's reacted, interest rates have reacted. So that's another factor we're going to be focusing on there. And then finally, on the credit side, I think the main focus is going to be looking at that balance between corporate issuance and if there still continues to be demand to absorb that.
Jeff, thanks for taking some time to give us an update on the markets, the economy, and the work the fixed income team is doing at SWIB.
Thank you, Chris. It's been a pleasure.
And thank you for listening. The SWIB Market Update is brought to you by the State of Wisconsin Investment Board and produced by PodCamp Media, branded podcast production for businesses, podcampmedia.com. Thanks again for listening. I'm Chris Preisler.